There's so many things happening right now. World trade is shrinking, and that almost never happens except in recessions or, during the Great Depression. The recession indicators have been signaling a recession for a long time. The long term, when I say long term, I mean the ones that have the best track record of being good predictors further in advance. So a lot of economists, and I would include myself, have said, there was going to be a recession in 2023. According to the data, that didn't happen. But it doesn't mean that the warnings were wrong, and it doesn't mean that we won't have a recession. It just means that it has taken longer to unfold than a lot of people expected. But now those same signs are actually getting worse. Unemployment report that came out about a week ago was completely misread. I mean, that was, the stock market went up, job creation exceeded expectations, unemployment remained constant. That was consistent with the happy talk, with the Goldilocks narrative, soft landing narrative, etc. And so kind of stocks rallied on that. But if you look behind the numbers, and there are two surveys, one of them showed about 220,000 jobs created. The other one showed 1.5 million full-time jobs lost. And then there were about 700,000, a little more, part-time jobs created. So if you net the two, you still lost 750,000 full-time jobs. And then, of course, part-time jobs aren't nearly as rewarding as full-time jobs. Hourly wages went up, okay, but there were fewer hours worked. That's how employers are managing the costs. Like, I'll pay a little more, but you work 30 hours instead of 40, so you're making less money. And then they gave a downward revision to the prior months. And for 12 months in a row, 11 out of the 12 months, they have downwardly revised the prior month's number. When you're like 11 out of 12 months, that's not random. There's a certain amount of noise in the data. Everybody understands that. But that's something seriously flawed in the model. You don't get that rolling the dice, getting a 6, 11 times in a row. It doesn't happen, or it's extremely rare. So there's something wrong with the model. So there's a lot less there than meets the eye. We have so far, but I think our luck has run out, if you want to put it that way. Germany's in recession. They just are. That data is clear and it's getting worse. Japan is kind of right on the edge, might be in recession. UK, same thing, right on the edge. In China, saying China's in recession is probably a stretch, but in China, if the growth goes from 10% to 7% to 5% to 4%, which it has over the last 10 years, that lost output is equivalent to a recession. China's trying to prop up their economy, so their economy is doing very poorly. When I see things like world trade contracting, with the trade figures, everyone focuses on surplus or deficit. So you have a trade surplus, your GDP goes up, you have a trade deficit, your GDP goes down, or did the deficit shrink? That makes GDP a little higher, etc. Forget about that. I mean, it's important data. But if you look at the top line, the exports and the imports, they're both shrinking. So whether the deficit gets a little bigger or a little smaller is less compelling, less important than the fact that both numbers are going down. World trade is shrinking. And that almost never happens except in recessions or, during the Great Depression. The Fed, of course, always says we're not political. We do what we're supposed to do. We follow the models. We're not political at all. That's completely untrue. They're highly political. They watch the headlines very closely. So they're aware of it. And you have to sort of put Jay Powell in context. He is a Republican, but he's a Bush Republican. There's no reason to think he likes Donald Trump or is a Trump supporter, et cetera. He's not a Democrat, but he's the kind of Republican who doesn't really like Donald Trump. My expectation is the Fed, for now, is not going to cut interest rates. They're done raising. That's pretty clear. You'd have to have some kind of inflation shock before they raise rates. That is unlikely to happen. Prices are going down. Well, sorry, the rate of inflation is going down. Prices are still going up. That's a big point of confusion. So prices are going up, but the rate of increases dropped from 9% to 3% in the past 16 months. So that's progress. 3% is still well above the Fed's target of 2%, but they think they're at what they call the terminal rate. The terminal rate is the rate where it's high enough to bring inflation down without having to raise rates more. In other words, it's high enough to act as a brake. Just give it time, and inflation will come down on its own without further rate hikes. The Fed believes they're in that position and they won't be raising rates. So the question is, when will they cut rates? The answer is when it's too late, meaning the Fed are usually the last to know. And the best example I can give you, they pay enormous attention to what we just talked about, the unemployment rate. 3.7%. That's one of the lowest unemployment rates since the 1960s. I mean, it is extremely low. But they believe in this Phillips curve, and the Phillips curve is an inverse relationship between inflation and unemployment. So the view is if unemployment is low, inflation is going to go higher. If unemployment goes up, inflation goes down. So they're seeing unemployment extremely low and saying, well, that's a little bit of a danger in terms of inflation, so we can't cut rates. But in fact, there are a lot of problems with that. First of all, there's no evidence for the Phillips curve. I mean, I can show you high unemployment, high inflation in the late 1970s. I can show you low unemployment, low inflation, in the mid 2010s and so forth. So you can find every low unemployment and low inflation during the Great Depression. So there is no Phillips curve. First of all, the Phillips curve is garbage. Secondly, employment is a lagging indicator. I'm not saying it's an unimportant number, but employers do everything possible to avoid laying people off. When revenues are drying up and margins are going down and profits are going down, they'll turn out the lights. They'll renegotiate the lease. They'll cut the laundry bill. They'll bargain harder with suppliers. They'll do everything they can except fire people, because people are hard to hire. You get the talent. It's hard to find. You train it. The last thing you want to do is fire them. So they will fire them. Unemployment will go up when they get desperate enough. But by then, the recession has already started. In other words, it's a lagging indicator that tells you nothing. So my point being, Jay Powell is looking at lagging indicators. If unemployment starts to go up, which I expect it will, he will cut rates, but we will already be in the recession. So he'll have political insurance, because they'll say, yeah, we're cutting rates, but hey, we're in a recession, we have to. They'll be in the political crossfire, but the economy will be so bad at that point, no one's going to blame Jay Powell. Let's go back just to the years before the war in Ukraine. So started at the end of February 2022. Well, for 30, 40 years since the end of the Cold War or longer, the Russian central bank had held a portion of their reserves in U.S. Treasury securities, dollar denominated, but U.S. Treasury securities in particular of different maturities, bills, notes, probably some bonds, mostly shorter term bills and notes. To their credit, Elvira Nabiullina, who's the head of the central bank of Russia, in my view, she's the only central banker in the world who knows what she's doing. She put 25% of Russia's reserves in physical gold. Physical gold held in custody in Russia, in Moscow. So the point being, you can't freeze gold. I've always liked that about gold. It's not digital. It's not electronic. You can't freeze it. You can say what you want. So that part is off limits. And they had some other types of investments. A big chunk of it, about $300 billion, which was about half their reserve position. Their reserves were about $600 billion. They had, $150 billion in gold. The last paper treasury security was issued like in 1979. They're all digital. They're all called the dollar, the original cryptocurrency, but they're held in custody, mostly in Belgium, but other European banks as well, other custodians, Deutsche Bank, UBS, and some in the United States, but mostly in Europe. Now, on day one of the war, within a matter of days, those treasuries were frozen. But let's define what frozen means. Frozen means you, Russia, you still own them, but you can't have them. You can't collect the interest. You can't sell them. You can't trade them. They're yours, but we're locking them up. And the U.S. Treasury and the Fed control the ledger so they can enforce that. They can make sure that those securities cannot be transferred. That's freezing. Now what they're talking about seizing them. Seizing is different. That's when you steal them. That's when you take them and say, hey, Russia, these are not just frozen, they're ours. We're taking them. They're not yours anymore. And selling them at the market and using the $300 billion of proceeds to finance the war in Ukraine. Not only are we taking your money, but we're using it to finance your adversary in a war. Now, a little background. As of now, there is no money for Ukraine. So where do you get the money? Well, maybe they can figure this out. But all of a sudden, Johnson and the White House say, hey, we got $300 billion sitting right here in the banks. Let's just take it and spend it on Ukraine. If you do that, you will destroy the U.S. Treasury market. I've been talking about it. Others have been talking about it. Maybe somebody will tap on the shoulder and say, hey, Mr. Speaker, do you understand what you're doing here? But Janet Yellen, who's sort of, not that bright, kind of does what she's told. She's going along with the White House view of this. They just think it's free money. They don't understand the implications. What country in the world would want to own a Treasury security, $1 worth, if you think the U.S. will take it if they don't like what you're doing? There's a lot of weight to the BRICS. And by the way, the BRICS is not a political union. It is an economic union with a focus on trade and currency. Yeah, China and India, they fought in the Himalayas. Saudi Arabia and Iran are both members. They've had their differences, et cetera. So to say there are all these political differences among the members and it's not a perfect marriage or whatever, yeah, but that's not the point. The point is they're working on a currency union and a free trade area, and you can have that. India and China can fight over the Himalayas all they want, but if they reduce tariffs and have a common currency, that's a big deal. And as far as, they've been talking about this a long time, they haven't made much progress. That's not true. They've made a lot of progress. They have the New Development Bank, which is basically a clone of the World Bank. They have the Contingent Reserve Arrangement, which is basically a clone of the IMF. They've spent a lot of the last 10 years duplicating the Bretton Woods institutions under their own control and for their own purposes. So they've sort of cloned Bretton Woods in a way they control. They're building their own communications networks. And here's the big thing, they had the Leaders Summit. I was one of the ones writing and talking about how it would be highly significant in terms of advancing the currency. The new BRICS currency is what we're talking about. Gold linked, by the way. And it sort of came and went, and people said, hey, Jim, nothing happened. Like, you were talking about this, and what was the big deal? Well, there was a very big deal, which was adding the new members. Because there's no point, what's the benefit of a bilateral trading currency? If it's India and China, it's easy to invent a currency. Just pick a name and print some, and there you go. But if India and China had a common currency, and India's shipped goods to China and got paid in that currency, what can India do with the currency? All you can do is buy stuff from China. You might need some stuff from China, but you want to go shopping everywhere else in the world. Same thing with Russia and India. So how do you make a currency union work? Well, the answer is you expand the membership so that when you receive the currency for your exports, you can spend it somewhere else. That's what the euro is. So the key to a successful currency union, you don't need a common fiscal policy. I mean, does anyone think Germany and Greece have the same fiscal policies? You don't need a genuine political union, but you do need agreement on we're going to have a common currency. We'll all be able to trade it among ourselves. The key is expanding the membership so that the currency is worth something because you can spend it in more than one place. Once you get that far and you agree on a central bank, and I said they already set up the National Development Bank in Shanghai, so they've got a bank kind of waiting to go. Here's the way I put it. They don't want to destroy the dollar. They don't have to. They actually kind of want the dollar around to do their dirty work. What they really want to do is free ride on the dollar. A unit of BRICS currency, called one brick, I don't know what they're going to call it, but it's called a brick. One brick will equal a weight of gold, not a dollar amount. They're not using dollars. It'll be a weight of gold, an ounce, a kilo, I don't know. Now, the weight of gold will have a dollar value based on the dollar gold market, because as you know, the gold market is overwhelmingly dollar based, which means that through a transit of law, A equals B equals C, so A equals C, the BRICS will have a dollar value, but it won't be linked to the dollar. It'll be linked to gold, and then the gold will have a dollar value, and you'll be able to, again, come up with a dollar value for a brick through a transit of law. But meanwhile, the dollar is the one that's got to go out there and hold up its end in the gold market. And so if you're the BRICS and you define your currency by weight of gold, what do you want to happen to the dollar price of gold? You want it to go up, because then your currency goes up.
Makes sense.
Right. So in other words, the dollar's got to do the dirty work in the gold market, and the BRICS can just free ride.
You say investors are relaxed because they believe the banking crisis is over. That's a huge mistake. Tell us why you believe it will come back to haunt us in 2024.
First of all, that's what history shows. And none of these things are completely deterministic, but financial history can be a pretty good guide. And you go back to 1997, 1998, what happened? Just very briefly, that crisis came to a head in September 1998 with long-term capital management and the Russian default. But it started in Thailand in June 1997 when they closed the capital account and devalued the Thai baht. And that started a panic throughout Asia because everyone assumed that all these pegs to the dollar were safe and you could put dollars into Thailand and Indonesia and so forth and not have to worry about the exchange rate. And all of a sudden there was a run on the bank. I talked to Dr. Mahathir, who's the Prime Minister of Malaysia, about this. He was the only guy who kind of got it right. But once Thai did that, then there was a sequential collapse, bank run, if you will, in Indonesia, South Korea, Malaysia, etc., throughout Southeast Asia. But then it calmed down in the winter. And it was very serious in the fall. I mean, people were getting killed in the streets in South Korea. But by December 97, January 98, February 98, it had died down. It looked like it was over. And I was at long-term capital management. We weren't worried about it. We were looking at expanding our business in Asia. And we actually paid a $3 billion all-cash dividend in December 97. And that's how confident we were. We gave $3 billion back to our investors. But then by April, it started to hot up again. And then the Russian default was in August and the LTCM meltdown was in September. So that had 2 stages, but a quiet period in between. Same thing in 2007, 2008, the global financial crisis. That really took off in the spring of 2007 with the mortgage losses. And then, we all remember Jim Cramer's, they know nothing.
They know nothing!
But then it died down in the winter, but it came back with Bear Stearns. So these things do have 2 stages. We're in a quiet stage right now, but I expect the banking crisis will return. When you say it's here to stay, gambling is here to stay. They gambled during the French Revolution and they gambled in 19th century London, and you can go to Las Vegas or Atlantic City today. So gambling is here to stay. It's not a particularly productive activity. It costs people more than they make, but it's a form of entertainment. So I think of Bitcoin as a form of entertainment. I think of Bitcoin as a casino chip. Okay, so you go into a casino, you put $1,000 down on the roulette table, croupier gives you $1,000 worth of chips. You gamble. You could make money or lose money. When you're done, You pick up your chips, you go to the cashier and you get dollars and you go outside. In the world of crypto, you can buy and sell Bitcoin all day long and you can calculate dollar profits. But if you want your profits, you have to sell it, get your dollars out of that world and go back out on the street. But the Bitcoin itself has no value outside the casino. If I walk out of the casino with the chips in my pocket and try to buy a cup of coffee with the chips, you can't do it. I mean, maybe somebody will help you out, but basically you got to convert back to dollars. So Bitcoin are chips in the casino. You can gamble, have fun, kind of entertainment, make money, lose money. Most people lose money, actually. Some people have made it a lot. It's true. Just keep the gold. You have the gold for the day when the dollar's not worth anything. That's why you have the gold. So that's number one. Number two, tell me the use case for Bitcoin. I mean, there is no use case. As a form of speculation, as a form of gambling, yeah, it's the chip in the casino. I'll grant that. People tell me, oh, Jim, you're technophobic. You don't understand. I read Nakamoto's paper in 2009 when it came out. I've been in gold Bitcoin debate since 2010. I never lost, by the way. Yes. So I get it. I get the technology. I get the math. But I also understand monetary economics. And there is no use case for Bitcoin except for entertainment. There are a number of factors that drive the price of gold, and you know them. You start with supply and demand. Supply has been constant. Global mining output hasn't gone up or down very much for about 6 years. It's pretty flat. Demand is going up, not because of retail. Americans don't understand it, but central banks do. And you know, Russia, China, Mexico, Kazakhstan, Vietnam, long list of central banks have been acquiring gold. By the way, they're acquiring more gold now because this whole treasury bill confiscation we talked about earlier. So when demand is up and supply is flat, that tends to drive prices higher. So that's a good start. But the biggest factor driving gold prices recently is declining interest rates. So if you said, Jim, give me your forecast for gold, I would say, well, let's start with the forecast for interest rates. And the forecast for interest rates is they're going to drop a lot, very steeply. They already have. The yield to maturity on the 10-year note dropped from 5% to 4% in like the blink of an eye. It was like a couple of weeks. It's going to go to 2 or lower because now we're back to the recession. You get the kind of recession and disinflation, even deflation that I see that we're talking about, then interest rates are going to come down a lot, and that's going to send the price of gold a lot higher. It's good to be prepared. By the way, you can make money in downturns. You just have to see it coming.
Jim Rickards emphasizes that the global economy is facing significant challenges, and 2024 could bring about a severe financial crisis. He highlights that world trade is shrinking, which typically only happens during recessions or periods like the Great Depression. Despite previous predictions that a recession would hit in 2023, Rickards argues that the warning signs are still present and are worsening, particularly in terms of employment data. He points out that recent job reports were misleading, showing job creation but hiding the loss of full-time jobs and an increase in less stable part-time work. This, combined with revisions that have consistently shown lower job creation than initially reported, indicates deeper economic problems. Rickards critiques the Federal Reserve's handling of the economy, particularly their focus on lagging indicators like unemployment. He explains that unemployment is a lagging indicator, meaning it only reflects changes in the economy after they have already occurred. By the time the Fed reacts to rising unemployment by cutting interest rates, the recession will already be underway. He suggests that the Fed is too slow to respond to economic realities, and their reliance on outdated models like the Phillips curve, which posits an inverse relationship between unemployment and inflation, is misguided. He also touches on the geopolitical landscape, noting that key economies like Germany are already in recession, with Japan and the UK on the brink. Even China's growth has slowed significantly, which, while not technically a recession, results in lost economic output equivalent to one. Rickards argues that this global economic slowdown is contributing to a contraction in world trade, which is a clear indicator of an impending global recession. Rickards is particularly concerned about the U.S. Treasury market, especially the possibility of the U.S. seizing Russian assets to finance the war in Ukraine. He warns that such a move would destroy confidence in the U.S. Treasury market, as no country would want to hold assets that could be seized if the U.S. disagrees with their policies. This could lead to a significant loss of trust in the dollar and push countries to seek alternatives, such as the BRIC's currency being developed by emerging economies like China and India. He explains that the Briceous nations are working on creating a currency linked to gold, which would allow them to bypass the dollar. This currency union, Rickards suggests, would provide a serious challenge to the dollar's dominance. By linking their currency to gold, the Briceous nations could effectively free ride on the dollar's value while setting up a system that could eventually replace the dollar in global trade. Rickards is also skeptical about the current state of the banking sector. He predicts that the banking crisis is not over and will return in 2024. He compares the current situation to past financial crises, which often have two stages: an initial shock followed by a quiet period, then a second, more severe crisis. Rickards believes we are currently in the quiet period, but the underlying issues in the banking sector are still present and could lead to a more severe crisis next year. On the topic of cryptocurrencies like Bitcoin, Rickards dismisses them as speculative assets with no real value outside of the digital world. He compares Bitcoin to casino chips, which can be used for gambling within the casino but have no value in the real world unless converted back into dollars. While acknowledging that some people have made money with Bitcoin, Rickards argues that it lacks a real use case beyond speculation and entertainment. Finally, Rickards discusses the factors driving the price of gold, noting that declining interest rates are likely to push gold prices higher. He explains that central banks, especially in countries like Russia and China, are accumulating gold as a hedge against the potential collapse of the dollar. With interest rates expected to drop further due to the impending recession, Rickards predicts that gold will become an increasingly valuable asset, offering protection against economic instability and currency devaluation.